Welcome to our webcast, the First Financial Forum. We're so pleased to have you with us today. We host our webcast covering important topics pertaining to banking, the economy, and the financial sector. I'm Bliss Morris, the founder and CEO of First Financial Network. We work closely with some of the largest banks in the nation, regional banks and community banks, the FDIC, U.S. Treasury, and other regulators. We are celebrating our 34th anniversary in the business as the first loan sale advisory company. So I'm very proud of that, and I work with absolutely the most wonderful team in the industry. I'm so excited this morning to introduce you to our esteemed guests. It is absolutely my pleasure. First of all, I'd like to introduce you to Annemarie DiCola. She is the CEO of Trepp Inc., director of Trepp's executive board. She spearheads its business and has for many, many years. Trepp is the global leader in the CMBS industry, expanding its expertise and solutions into the broader CRE finance, banking, and corporate credit CLO sectors. Annemarie served as the first, and this is really important, and it's something she should be very proud of, and I know that she is, and I'm very proud of her for it, as the first woman chair of the Commercial Real Estate Finance Council, known as CREFC, a well-known trade association for the approximately $4 trillion CRE finance industry. She currently co-chairs the advisory board of the NYU Stern Chin Institute for Global Real Estate Finance, as well as serving on the advisory board of the NYU Furman Center. I'm also very excited to introduce you to Dr. Edward Altman, also known as Ed, the Max L. Hine Professor of Finance Emeritus of New York University, Stern School of Business, and Director of the Credit and Fixed Income Research Program at the NYU Solomon Center. Ed is best known, and I'm sure many of you in the audience today know this, for the development of the Altman Z-score for predicting bankruptcy, which he published in 1968, and it is still utilized today, which to me is amazing. Dr. Altman is also a leading academic on the high yield distressed debt markets and is the pioneer, and to be a pioneer is really something, in the building of models for credit risk management and bankruptcy prediction. So Annemarie and Ed, thank you so much for joining me today. I'm truly honored. It's a privilege. I met Annemarie through a mutual friend back during the global financial crisis. Ed and I actually met at a conference in Stockholm. So that's been just a few years ago, pre-COVID. And I was thrilled when they both agreed to be on the webcast today. So our focus today will be on where are we at in the credit cycle and related economic, real estate, and financial issues. There's many of them to discuss, that's for sure. And we're going to take this discussion really wherever our guests want to take it. We talked yesterday, and I said I really want them to lead with their expertise, their thoughts, their foresights. So it'll be a very open discussion that I am certainly looking forward to sharing with all of you. So I want to start out by talking a little bit about what's been going on here recently. So as we all know, Mr. Powell, who's got a lot of challenges for sure as chair of the Federal Reserve, has been fighting inflation and has raised the federal funds interest rates 11 times since March of 2022. Although the Fed has paused on raising rates since the September Fed meeting, there are various opinions as to whether the Fed may increase the rate again before year end or at some point in the early near future. GDP increased, and Ed brought this to my attention yesterday, 8.5% at an annual rate in the third quarter to a level of $27.62 trillion. There are so many economic factors and financial risks that could play out. During my career, I've never been so perplexed, I guess is the best way for me to put it, as to the future outcome of the effects of many factors on the financial sector. And with that, Ed, I want to lead with you. Where are we, in your opinion, in the credit cycle? And what are your thoughts in terms of the key economic indicators we should be analyzing in the potential of a crisis?
Thank you very much, Bliss, and good morning, everyone, and thank you very much for having me today. It's a pleasure to be with Annemarie as well. When we ask the question of where we are in the credit cycle, I think it's important to define what we mean by a credit cycle. Most people know what a business cycle is, but the credit cycle is something that is more perhaps less clear. So let me give you the spectrum. We were in a benign credit cycle for most of the period since the great financial crisis. And a benign credit cycle means low interest rates, high liquidity, low defaults. And if there are defaults in whatever market we're talking about, the recovery rate to investors is usually quite high. And that was the situation literally since 2010 until just a short time ago. The next level of credit cycle is what might be called average. And there we look at the historic data to look at a number of indicators that I'll talk about in a moment that were average over the last 40 or 50 years in the credit cycle. If things continue to deteriorate, so to speak, in terms of liquidity, higher interest rates, higher defaults, then you move to a stress cycle. And then finally, if we have the confluence of a major recession and an increase in defaults, et cetera, you could have a financial crisis. So that's the spectrum: benign, average, stress, and a crisis. Where we are today, I look at essentially 5 indicators. And these indicators are what I look at, not necessarily what someone else in the credit industry might look at, in order to determine where we are today and the outlook. So first is default rates. And I was very fortunate that I was asked by Morgan Stanley back in the early 80s to analyze for them whether they should get involved in this new market called high yield junk bonds. And that gave me, as an academic, the entrance into a new market then. It was a tiny little market. And today it's about $1.5 trillion in bonds. And if you add leveraged loans, you're talking about another $1.5 trillion. And then there's the non-bank market, which is another $1.5 trillion. Some people think going to $3.5 trillion in the next 5 years. So you have this leverage finance market that I concentrate on. First indicator is defaults. And there are various technical definitions of defaults, but we all know a default is a very serious situation for a company. Historically, the average default rate for high yield bonds is 3.3%. And very interestingly, today, year to date, as of essentially today, we are at 3.3%, just about the historic average. And so if we extrapolate for the rest of the year, we're probably talking about slightly higher than the historic average. So first indicator, average or slightly above average risk. Second indicator is recoveries from defaults. Historically, on bonds, it's about 45 cents on the dollar. And for loans, 65 to 70 cents on the dollar, because they're usually secured and more senior. Where we are today is 37% is the average recovery on corporate bond defaults. So this is one signal that the market, at least supply and demand for defaulted bonds, is skewing more toward above average risk and lower recoveries. There is a definitely statistical inverse relationship between defaults and recoveries. But we're at average risk for defaults, but above average risk for recoveries. Third variable is what investors are requiring as a rate of return on risky debt. Here is where I'm perplexed, Bliss, as well as you are. Because I would guess that with the above average default loss right now, and the outlook of a possible recession, investors should be requiring a higher than average rate of return.
Yes.
But it's just the reverse. Investors are now requiring about, I would say, 4.25% spread over treasuries. And so if treasuries are about 4.5% now, a 4% spread would make it about an 8.5% required yield. When I would think in today's market, it should be quite a bit higher. So if the market is right, then maybe defaults going forward, and especially if we don't have a recession, will not be so grave, and the high yield and leverage loan market, and indeed most credit markets, will do quite well. I'm surprised, to be honest with you, that investors are not requiring a higher spread, and I can come back to that later on. The fourth indicator is something that I coined the term distress ratio back in 1990 when I was asked to do a white paper on distressed debt. It was an infant industry at that time. Now it's an established asset class of distressed debt investors, as you know. And that distress ratio is the percent of high yield bonds trading at more than 10% above the risk-free rate. So that would be around today, in today's market, around 14.5% or higher. And that historically is about 8% of the high yield market. And guess what? We are exactly at 8% today. And so that's average risk. Finally, liquidity. And this is probably the most important of the 5 variables that I look at. And I might add the most difficult to forecast. And the reason it's so difficult to forecast is it can change overnight. And as Annemarie probably knows, that's a key factor in her realm of commercial real estate, which I'm sure she'll talk about. Now, somebody once said, never forecast. But if you do, never put it in writing. But if you do it frequently. And that's what most forecasters of the credit cycle do. They do it frequently. And I'm referring to rating agencies and some investment banks and other crazy people like myself that look at that market. But the liquidity is so important, and liquidity was really, really high and ample until 2022 in the high yield market. Last year, and so far this year, it's come down. It's still there. There is still liquidity in high yield bonds. I expect this year that about 135 to 150 billion of new issue high yield bonds will be issued. But the historic average in the last 10 years anyway is probably 250, 275 billion. So it's somewhat below. So it's a little bit indicator of higher risk. I particularly look at the CCC tranche. If those fellows and ladies can issue bonds, anybody can. But in a liquidity crunch, along with small and medium-sized firms, which is a new passion of mine, those two areas suffer the most: the CCCs, B minuses, and the small and medium-sized firms. So in conclusion, looking at these 5 indicators, I would say that we are, at least with respect to historic data, an average credit risk environment, trending more toward above average. But here's my suffix to that forecast. Is it really average? And I don't know if you want to get into it now, and I could explain it a little bit more. I look at default rates, particularly in the high yield and leverage loan market, as a leading indicator of economic recessions. And all the indications I'm looking at is a trend in increased default rates starting in 2021. Yes. Of course, it was during the pandemic when default rates were minuscule. 0.5% compared to a historic average of 3.3.
Mhm.
Then it jumped to 1.5%, but still below average in 2022. This year, okay, let's say 3.5% or so is the potential likely default rate. When WeWork went bankrupt, that added to the numbers, but it's still about average or slightly above. But the trend is very clear from below average to average or a little above. And every time I've looked at a recession in the last 4 recessions, except for maybe the pandemic, which really wasn't a recession, only lasted about a month or two, and it was very, very special. Every other time, when the default rate goes from below average to average, it usually, if you have a recession following it, peaks at 8 to 10, 12%. And that is potentially a very stressed or financial crisis situation. So the wild card is, what sort of economic environment are we going to be in 2024 and 2025 when so much debt comes due? And I can come back to that, Bliss, later after we give a chance to you and Annemarie to talk about other markets. But that's my assessment now. We are in an average or slightly above average credit risk situation today with respect to the indicators I look at. But with the huge amount of debt that has been built up over the last 30 years, particularly in the non-financial corporate sector and government sector, if we have a downturn and a problem in the economy, compounded with this trend of increasing default rates, we could have a very serious credit situation in 2024 and particularly 2025 when so much debt will be coming due.
You know, I totally agree with you, and your points are so important for us to think through. And that's what I love about hearing you, Ed, because you're so succinct in how you describe things that can be difficult for the average person like myself to understand. But it makes so much sense to me, because the confusion for me has certainly come from people saying, "Oh, we're on the other side of it," and I'm thinking to myself, when did it happen? Was I asleep at the wheel? So, you know, it's all your points are very important. And I want to turn to Annemarie, because Trepp has literally got the largest treasure trove of historical and current data and the analysis across the entire commercial mortgage-backed securities industry and other segments. I mean, you've expanded that, right? Since
banks and insurance company.
Yes, since you and I met. And I want to hear what your thoughts are in terms of current trends and the type of loans that are being transferred to special servicers. You know, I noted in one of the reports I read, because I do keep up with everything that Trepp is doing, and thank God I get information on a weekly basis, but that the special servicing rate dropped a tiny bit. I think it was 7 or 8 basis points, something like that, in October, to 6.8%, which is a pretty high, still a very high default rate, right?
Yes,
I mean, in
yes,
anybody's opinion. So is that a blip, or do you think this downward trend will continue? And also, what positive signs are you observing?
Okay. Well, the interesting thing about that particular fact is that although there was a slight reduction within that rate, the rate of office loans that went to special servicing went up. So there's still a very key component. And what I wanted to mention is, Ed, listening to your 5 factors, Bliss, if I may, I can extrapolate each of the factors to what we're seeing in the commercial real estate space. Because, Ed, you spoke about your focus on high yield bonds and other types of leveraged assets like that.
Right.
But hearing you delineate the 5 factors, I can recite a commercial real estate status relative to each of those factors that completely mirrors your assessment that we're moving from an average risk to above average risk, and the problems that could follow from that, potentially more stressed, as you laid out, which was so helpful, the way you laid out benign, average, stressed, and eventually a bigger crisis. You mentioned first default rates, to the point that Bliss mentioned about more loans still going into special servicing. Even with a slight reduction in the last month, it is still a high number of loans going into special servicing. And in general, what we are seeing is, although we saw we've seen and just reported on an increase in default rates in CMBS. That's the highest post-COVID number we've reached. It is still historically low when you think about the level we reached in at the end of in the GFC. But it is higher, it has grown higher. And when we look at it year over year, it's a significant increase in delinquencies in commercial mortgage loans in CMBS. We also track banks and insurance company loan performance, and those defaults are moving upward. They still appear low, but they are higher than normal. And we see more reasons why that may yet rise. So that is a concern to your point about default rates. Also, you mentioned the tight spreads in the bond markets that you cover right now. Spreads in CMBS have tightened as well. So again, something that's occurred there. When we think about distress rates, which you cited, we absolutely see an increase in interest in buying distressed assets. And we expect that there will be a rise in a distressed asset CRE market that has begun. And to your point about liquidity, while a positive is that despite all the factors that have affected commercial real estate, we do see some lease transactions taking place. We do see some sales taking place. It is certainly not at the level of transactions that were normal for our industry. So again, you would look at it and say there's been a tamping down of liquidity that isn't what is healthy for this industry. And so that's one of your 5 factors. To your point about debt, at Trepp, we are tracking $2.78 trillion worth of commercial real estate loans that are maturing between this year and 2027. Okay, so that is an enormous, you mentioned the $4 trillion CRE market. Well, $2.78 million worth of it will be maturing by the end of 2027. And what is important to focus on, Ed, again, to your point about the amount of debt and going into an environment of so much debt, those loans were either originated at the benign rates that you referred to, or they were refinanced at benign interest rates. Those borrowers are going into an environment where they have to refinance those loans at a time when interest rates are much higher than what was originally originated or refinanced, even if it levels off, even if the Fed begins to do some rollback in a year, you're still looking at an environment where a borrower is refinancing at a much higher rate than what they originally borrowed at. And at a time when the costs around that commercial real estate property have increased. Insurance has gone up tremendously. Other utility and tax costs have gone up tremendously. And also, because of the effect of inflation, the cost of materials for maintaining that property have skyrocketed. So this is a far more expensive environment for a borrower under any form of commercial property. This isn't just office's problem, it's every commercial property's problem. And to me, the way you describe the 5 factors, you can click off every single one of those factors and see above average risk plus brewing in the commercial real estate space.
So fascinating. I mean, how that how you describe how that dovetails in exactly what Ed was saying, but on the commercial real estate side. And, we are seeing some very interesting things with our banking clients. We've got several large banking clients that have been extremely proactive in the last 3 or 4 years in terms of selling performing commercial real estate loans. And you think to yourself, well, why would they sell a loan? Well, if it's basically a one-off borrower relationship and there's no other fee income associated with that, it's a better use to sell the loan and use that capital in another way.
Correct.
The other thing, though, that we've been seeing, because we have a lot of loans that come through the shop just from the perspective of being valued for a market value purpose. They may not be sold. We work with a lot of the federal home loan banks on valuations, market valuations, but there are a number, I would say a lot, of banking institutions that have not had new appraisals done on commercial properties in recent years, because there will be on a lot of those properties, not all for sure, but a lot of them, a significant decline in value.
Yes.
We're also seeing the number of non-performing loans, distress, to your point, increasing.
Yes.
And so I think it's the horizon for what could happen is
the valuation issue is a huge one in commercial real estate, Bliss. It really is. That's the big question is what is this particular property worth now in light of everything? It is another complication.
That's always an issue on the recovery rate area, that if you're in a situation when defaults go up, okay, that's one hit. But usually what happens when defaults go up, valuations go down of the assets that might be behind those loans or bonds. And therefore, the investor who was there at the beginning gets double hit. And that's what stress testing is all about. You want to take what's the worst case scenario or the negative scenarios. Until we did our study on the correlation between default rates and recovery rates, it was generally practiced that a bank or another type of lender would estimate expected losses based on pretty good data on defaults, but then would plug in average recovery rates rather than what usually is the case is much lower recovery rates when defaults go up. And so that kind of changed the way stress testing evolved with respect to capital requirements for banks with respect to the expected and unexpected losses. So it's all what Annemarie said about the valuations is mirrored in that lower recovery rates that we're seeing for bond defaults as well.
Right.
Yes,
exactly.
absolutely.
And the value of the property absolutely complicates the whole refinancing exercise, because now you want to borrow against a building that you had borrowed against at a much higher valuation. Now it's not worth as much. You have loan to value issues, loan to value ratio issues. You have debt service coverage issues, and the willingness. I mean, we are seeing some lending certainly take place right now, and we are seeing some leasing certainly taking place. However, those are with absolutely the A+ borrower operators of buildings, highly tenanted buildings, leasing in highly amenitized, highly modern buildings. The better the product, the more likely that they will find capital, that they will find the tenants, etc. But there's a lot of B and C class commercial properties in the U.S. that will struggle. So I agree that we are moving from above average risk toward much more stress. The story of CRE is going to play out over time, and it's going to take time.
Interesting, Annemarie. And this is what I'm finding in the data I'm looking at. The real estate sector is one of the lowest default rate sectors in the bond market. So it's all the action is in the loan market, and that is mirrored by, I didn't mention this, Bliss, at the outset. While the default rate on corporate bonds is about average this year, or slightly above average if we extrapolate by the end of the year, the default rate on leveraged loans in general, which would include real estate, of course, is much higher than the historic average. I mean, that's different. Leveraged loan default rates are probably going to come in at 4 to 5%, where the historic average is maybe 2 to 2.5%. And so that area, particularly because most of the loans are floating rate, is the area that is definitely already experiencing much higher than average risk. And I have to defer again to you and maybe others. What's the spread on those on those loans? Are they still below average? And why?
It's interesting. I wanted to actually speak to the default rate. It's interesting what you said about the default rate, because currently the default rate in CMBS is up to 4.63%.
Okay.
So it's interesting because there's clearly a mirroring of the factors that Ed is seeing, and in the markets that he covers, and the commercial real estate space.
Based on everything you both are saying, I'm sitting here wondering. I would love to know, because I know both of you were obviously very active in your areas, professional areas, in terms of the global financial crisis. What is different now today versus the GFC? I'm curious as to what your thoughts are about that.
Well, one thing that's very different is the spread. The spread during the GFC, even before it got to its height of over 20%.
Correct.
And now we're talking about 4%. But in December of 2008, the spread of high yield bonds over comparable duration treasuries was over 20%. And when that happens, liquidity dries up completely.
Yes.
Of course, we're not at that now, and the liquidity has not dried up. If things improve, and especially now that they're saying inflation look like it's, the latest reports are that it's leveling off and maybe continuing to drop, and that's going to mean that interest rates won't be raised and possibly will be reduced in 2024. Then we can talk about a scenario that's not so grave. But my biggest concern is some catalyst that we do not expect now, or it's not imputed in prices now, on top of that huge debt increase that Annemarie and I have talked about. And I have some staggering numbers on those debt increases if anybody's interested. If one or two of those catalysts hit us, again, one that we didn't expect, or now we're beginning to expect more and more with respect to geopolitical issues, then the liquidity situation is going to really dry up as investors pull back. That's my biggest concern. Yes, the trend is not great with respect to 2024 and 2025, with so many maturities coming due, as Annemarie mentioned as well, through 2027. But it's that catalyst that usually triggers a financial crisis. And that's, what we've experienced every time. It's something we didn't expect, is always out there in the shadows, and I just don't know what it would be, but it's usually something we didn't expect.
Well, to your point, I mean, Ed, the geopolitical issues are huge. I mean, what's happened with the war Oh, with Russia and Ukraine, I was sharing with Annemarie before we started working with U.S. Treasury in 2015-16. There was a huge banking crisis in Ukraine. So that country is near and dear to my heart. We still have a couple of employees there. We're not working. There's nothing to be done, but there's predictions that if and when that war were to come to an end, that there'll be even a larger banking crisis in that country than there was before, with over half of their banks failing. And then, of course, everything that's happened, with Israel and Gaza. Jamie Dimon speaks about it frequently. He does not ignore it. And I think, to your point, Ed, those are very, very important things to be thinking about. And Annemarie, I'm go ahead. I'm interested in.
Well, it's interesting. First of all, I agree with everything that Ed said in terms of what's different. And I would add to that, I think when you look back at the GFC and you look at some of the underwriting that took place in the residential markets and the exuberance of a lot that happened there that formed a hub of a number of problems that followed. In the years since, underwriting standards and discipline took place across lending institutions in both residential and commercial. And I think what we're looking at now with some of the issues that the commercial real estate industry is facing is a little function of, it's not their fault, but it's their problem. Okay. The issues that we're looking at with delinquencies and defaults and problems are far less an issue about not managing buildings well, not having made smart investment choices, not having good loan terms. As I said, a lot of these loans were actually on benign numbers, of the word Ed is using. But I think you can't discount the impact of the pandemic and the lockdown and what that did to the utility of real estate, commercial real estate in this country. And depending on where you lived and worked, you were home longer or less than others were. But major central business districts of some 24/7 cities really took a beating in the form of people getting used to not going to the CBD, but staying home, working from home, and then frequenting retail and other things near home and not in the middle of the city. And so you look at New York, you look at San Francisco, you look at Chicago, you look at Boston, you look at a number of cities where they were mass transit reliant and people stayed home longer because we were afraid of being too close on a commute until we were all vaccinated and we thought things were passing, and new habits were formed. Yes. And a lot of business leaders, and I don't fault any business leader, and I think every business leader should have thought of this. A lot of business leaders looked at whether their company and their staff were all productive during this. And they're asking themselves and have asked themselves, do I need as much space?
Sure.
Because you have an obligation to your company, to your investors, to your shareholders, to use your money wisely. And I think what we are seeing in the commercial real estate space is a reset in the way people use space and where they use space. And that is part of the issue here. The other thing that took place while all of that was happening, and particularly, again, the 24/7 cities were hit the hardest, you had a degrading of quality of life in those cities in the form of increased crime.
Yeah.
Other quality of life issues around sanitation, and other social problems created by the emptiness of the center of the city. Yeah. We see that in New York. I know it's true of other cities. It's affected San Francisco in a very big way. And so I think what's different here versus the GFC is that, again, you look at, I see empty storefronts. I see buildings that I know are not fully occupied by their tenants. And that is not the fault of the owner of that building not having managed it well.
Mhm.
But it is the ramification of coming out of a period
It's a
where we
paradigm
were
shift. It's a paradigm
locked
shift.
in,
Yeah.
you know? And so I, for one, think that the country is going to be undergoing a reset about where work is done and how work is done, and it won't be a one size fits all. So the 5-day in-office work week for every company in this country, I think, is gone. For some companies, that's absolutely correct. For other companies, it will be some hybrid. For
Mhm.
some roles, it may be 100% remote. For others, it may be 5 days a week. And I think that we're entering, and this creates a variable. And, the presumption that more people will yet return to the office. And frankly, I hope all junior people early in their careers go to the office as much as possible,
I do
because
too.
I think it's the best place for them to learn.
Me too.
But I think that the function of whether more people go back to work in an office is not merely how amenitized it is and how modern it is, but it also relies in large part on the municipality and what it has done about crime rate and quality of life issues as well.
No, you're absolutely correct. And we talked about this a little bit, you and I, with the COVID shutdown. I mean, our staff could not wait to get back in the office. So most of them were back in the office by late June, early July 2020.
That's fantastic.
Mainly because everything we do is very collaborative. We don't have the big commutes that you have up in the Northeast and other cities, right?
Right. Nobody was on a crowded subway, right?
No. And but I have seen it in my travels, and everything has definitely shifted. If anyone had said to me 4 or 5 years ago that the majority of the bankers and investors that we work with, and those are investors in some of the largest international funds, these are some of the largest banks in our country, and regional and community banks, would be working from home still,
right?
Maybe like 3 days a week, I would never have believed it.
Exactly.
But that's
I have a question on this demographic and workspace, work location change. How do you think, and I haven't thought about it until this very moment, so this is brand new. Do you think that the subject of risk management will suffer or will have no effect with this change? And the reason why I bring that up is I think that when you're home alone and you're dealing with day-to-day things, you don't get a chance as easily. Sure, you could do it through Zoom or Microsoft Teams or whatever software you use, but you don't get the same sort of collaborative discussion of, especially for risk managers, among themselves, and when they talk to the product people about what's going on. Well, it's a lot different than if you can walk down the hall and talk to them, as opposed to over Zoom.
Could not agree more.
Yes, Ed, you're spot on, and a point to that. So during my career at FDIC, I worked on, I don't know, something like 35 different bank closings. Some of them very, 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 very small rural banks, all the way to Golden Pacific Bank right in New York. You all might remember when that bank failed. It was a really big deal.
Sure.
Well, think about what happened in March. Silicon Valley Bank,
Right.
Signature Bank. So you have regulators trying to control a situation where the majority of their staff, including executives, are working from home.
Wow, exactly.
And that's really stunning, because you don't have the collaborative nature to be able to say, how are we going to deal with this? Because this is a minute by minute crisis unfolding.
Yes. No, a very good point. That's a really good point, Bliss. And I completely agree. Could not agree with you more. I think much is lost by this hybrid arrangement. And as I said, I think different businesses are finding what is appropriate and right for them. And in the examples you both described, clearly, being present, there is no substitute for being physically present and as in touch as possible that way. It's interesting too. I went to NYU Law and I began my career in law as a commercial real estate attorney. And I was joking with somebody recently. I said, here we are talking about hybrid work environment and who's coming in 3 days a week and what company's doing 2 and 3, et cetera. I said, beginning my career in law firm life in New York City, it wasn't a question that you were in 5 days a week. It's when you were also coming in on the weekend. So, it's alien to me to be in this type of environment, but it is a trend that can't be ignored. And it is in when you look at commercial real estate, it's absolutely impacting it very directly. There's no question.
No
And you know
doubt.
what I think too, to add to your point about risk management suffering, which is a critical issue, I wouldn't rule out that in some period of time, some things will move back. But I think that might only be after some businesses learn some expensive lessons of what was lost by not having people much more present together in the office. But that's not going to happen in 3 months. I think that's another thing that will play out over time.
I do too. And I think we would be one of the things I want to talk about, because we don't have a whole lot of time left, maybe 15 minutes, because it's a huge sector in the financial industry, and that is really the shadow banking, the non-bank lenders. And Ed, I would love for you to share with the audience some of your thoughts about that.
Well, I completely agree, and I was blown away myself, knowing to start with how large that industry has become.
Yes.
With some of the forecasts about how large it likely will be in 5 years. And that is, in the US anyway, going from $1.5 to $3.5 trillion outstanding in non-bank, high yield bond, leveraged loan area. Right. So on the positive side, that industry, if you call it that, has come to the rescue of many firms, yes, it has. Especially highly leveraged companies in this reduced period of bank lending. And so it's filled a void, so to speak. And some of that is because those folks outside of banks can charge more. And the customers, will pay it because it's the only game in town. But in addition to that, we're beginning to get better, but still much less information about that industry compared to the more established bank loan, high yield bond, leveraged loan industry. For example, default rates. If you ask the average person out there who's in the industry, how have non-banks, shadow banks done in this period of rising default rates? People would probably scratch their head and say, well, I don't know, probably it's lower, but, because they know their customers better, perhaps, than, the bond market does. But how much better, or maybe it's the same. So, but we are beginning to get some data on that. And to give you what I've seen, where the default rate for high yield bonds now is around likely to be 3.5% this year, and leveraged loans maybe 4.5 to 5. The rate on direct lending, shadow banking, so to speak, is probably below 2%. Or at 2% at the max. So that's with some data that I've seen that's out there from KBRA and some people who are following that market, but very few people have good data on it. Right. the other thing is there's going to be a bigger demand for performance statistics of the companies in the portfolios of non-bank lenders.
Yes.
I was very pleased to have the opportunity to build a model recently that looked at year-over-year performance, revenues, and cash flows of portfolios of direct lenders, and one in particular, and to follow that each quarter. And particularly what's called the middle market.
Right.
And the middle market is defined in various ways. I define it as cash flows between, could be negative, but zero, and say 75 to 100 million for companies. That would be my definition of a middle market company. It's not the same of a middle cap among mutual fund investors, which is much higher. But anyway, so to get back to your question, there could be some positives in terms of filling the void. The negative is, of course, with that enormous growth and basically unregulated, you have the possibility that that industry could shut down in a crisis.
Right.
And given that it's so large, it would cause enormous, or it would result in enormous liquidity problems in general.
Yeah.
And so, there's a lot to say about that market.
And I certainly agree with you with the potential negatives, but it's interesting, again, in drawing another parallel with the CRE industry, Bliss.
Yes.
When we think about some of the issues that the CRE industry is going to be dealing with these upcoming maturities, et cetera, the question is, okay, where will the capital come from? And how do we solve it? And one of the positives that people look to, in addition to creative financing arrangements, perhaps loan assumptions, et cetera, is more non-traditional lenders entering the space or being in the space in order to support some of the capital needs that these maturing loans will require. So
absolutely,
we agree it could be a bane and a boon, but they are thinking of the non-traditional lender space as a part of a solution here when we look at that those maturing loans.
Well, and I wonder too, if the demand decreases for those shadow bank lenders in terms of the need for credit, I wonder if that industry would experience the same sort of thing that we saw in the residential lending market. Rates started to rise. What did we see? Huge layoffs. Companies being, large residential originators being sold, or shrunk to practically non-existent. So, I think that's another, possibility as well. It's hard to know, but that would be a kind of demand situation. So
another factor to consider is, and I don't know the answer to this question exactly, but I could give you a ballpark. What percentage of American companies are owned by sponsors like private equity firms? And if that percentage is as high as 30 to 40% is what I think is the right number, but I'm not sure. At least the number of companies, not necessarily in total assets. Then you have the potential, if there are big swings in liquidity, to really impact the economy. Whereas if you go to other parts of the world like China, where I just came from, the percentage is, under 5%. They've got another problem. By the way, they do have in China, for people who are interested, a very large non-bank lending market, and they're called trusts there rather than BDCs, for example. And the trusts are companies that loan money to individuals, but primarily to companies that simply are too small or not as important to the government in terms of state-owned enterprises to get loans. And so those trusts were for a long time fueling the increase in leverage in the Chinese system. Now those trusts themselves, unlike our shadow banking, are coming under a lot of duress. And in some cases, they can't pay back their investors.
Yes.
Which is a potential major problem for China. And just imagine, if that disease, if you will, transmits to other countries.
Yes, that is a fascinating point. Well, we have about 5 minutes left, and I can't believe how quickly this hour's gone by. I would just like to maybe end our conversation with both of your thoughts in terms of, both of you have such an enormous amount of experience in analyzing financial and economic data. If you could just name one or two things that concerns you the most in the near term regarding the U.S. financial sector and our economy, what would those be?
Well, I could say Annemarie, you want to go first? But I'm happy to go as well. One thing that I wasn't so concerned with until I looked at the numbers is the waterfall analysis of maturing debt. And if you look at what sectors are having the most debt mature in the bond market anyway, speculative grade maturity waterfall, they are as follows. Media and entertainment is the largest one coming due in 24, 25. Second, believe it or not, I was surprised to see, is high technology. Third, healthcare. Fourth, consumer products. And fifth, telecommunication. So those 5 sectors in the bond market, maybe, and I'm sure Annemarie knows that the numbers much better than I in real estate, what's coming due, and she mentioned some of that data. So that's one area. The second one is this catalyst thing I mentioned. So that, and the third is, we still don't know, even though we are now kind of conditioned to change our minds on it, whether and how severe we'll have a recession in the next 2 years. Yes. And as I said, if the recession comes on top of the huge amount of debt and the waterfall analysis that I just mentioned, you have all the ingredients for a mini, if not maxi, financial institution and financial market meltdown. I'm not saying it's going to happen, not at all. I'm not predicting it, but I'm saying the ingredients are there that if things go badly with all that debt and now at higher interest rates than when they were issued, you have a big concern with the credit cycle.
Ed, I appreciate it that you're not predicting, because like you said to me yesterday, we hear people predicting things all the time, soft landing, hard landing, no landing. Right. It's not very helpful. Annemarie, your thoughts before we close?
Well, certainly agree with all of the concerns that Ed raised. And I think what I would add is that I think what worries me the most is that the political situation within the U.S., and not just in Washington, but the need for more work with the administrations running cities and states. I think that for the commercial real estate industry, the resetting, the remaking of many things that will have to take place, I think more public-private partnerships are going to be necessary, more cooperation with the city officials, the building departments. A lot of important work is going to take place. And I don't think we have the level of cooperation and the spirit of nonpartisan approaches to solving business problems between government and business at every level in this country. We don't have the amount of cooperation that we need. And it would be one of my favorite expressions. First, I want to credit Sam Chandon at NYU, who's been pushing for public-private partnerships a lot. But also, one of my favorite expressions that came out of the GFC was, a crisis is a terrible opportunity to waste. We stand poised at a lot of resetting in the commercial real estate industry. And done right, we could remake a lot of things in cities, in our towns, in suburbia, in our rural areas, relative to commercial space. We could do a lot of things for the better. But business owners can't do it alone. In addition to needing capital providers, they need the cooperation of their local governments. And we need that spirit in the US, all across the board.
We need it in Washington. That's a whole nother subject.
That's another hour.
That's another hour.
2 hours.
Right, right. I mean, because
Bliss, can I add a positive spin on things?
Of course.
With all these dire concerns, and I think there are legitimate ones, you have also the historic observation that when things turn around, and maybe in the commercial real estate, and Annemarie at least mentioned yesterday and today somewhat some of the what's called the green shoots and
Green
some of
shoots,
the
right. Some
right?
positives. There are some.
There are
Definitely.
some out there, but my guess is if an institution has liquidity, when things turn around, and maybe it's mid 2024, if the economy continues to perk along, or if things geopolitically settle down in one or more of those locations you mentioned, then the possible returns to those who have liquidity in those markets historically are phenomenal.
Yes.
Look at 2009, what happened.
Right.
And that was in general. So let's hope that things deteriorate further for a while, and then we begin to see turnaround, and that's the time when, if you have the liquidity to buy those assets,
Invest.
returns are phenomenally potential.
No question about it. And Ed, thank you so much for ending our discussion with that positive thought. And I want to thank each of you. And I look forward, hopefully, to seeing you when I'm in New York next month. And I did want to let the audience know that's participated today that we will be emailing you a document that Ed penned recently. Where are we in the credit cycle? An average current scenario, but is it really average? So I know you all will find that of interest. And again, thank you very much. And I just absolutely appreciate the discussion. It's been so interesting, and I've learned so much from the two of you today. So thank you.
Enjoyed it as well. My pleasure.
Right.
My pleasure.
Have a great day, all.
All right.
Thank you, Bruce.
Thank you. Bye-bye.
Bye-bye.